Okay. Hi.
Hi.
My name is Steve Check. I'm from Costa Mesa, California. My question is regarding stock options. I've taken your suggestion and have been attempting to subtract stock option compensation from reported income when evaluating companies. When I read annual reports, I usually find companies estimating option costs using the Black-Scholes model. However, the assumptions going into the Black-Scholes model seem quite different from company to company. These assumptions, of course, are what is used for risk-free interest rates, quote-unquote risk-free interest rates, expected option lives, even though options have stated lives, and expected volatility. Help me out a little bit. What is the best way to calculate option costs? Do you think Black-Scholes is appropriate? If so, how should we normalize the assumptions? And just one short follow-up. How can we possibly estimate future earnings for companies when companies, such as even Microsoft last week, in response to a lower stock price, simply reissue a bunch of new options?
Yeah, I can tell you from some personal experience that companies attempt to use the lowest figure they can, even though it doesn't hit the income account. So they like to make fairly short assumptions as to the life of the options, even though they're granted on a 10-year basis, because they'll make certain assumptions about exercise date or forfeiture and so on. I think the most appropriate way, when you've got a pattern, which you have at many companies of what they do on options, is simply to make an educated guess as to the average option issuance that they're going to incur or they're going to elect to do over time. And generally, I mean, what you really want to, if you were to be precise, you would try to figure out what they could have sold those options for in the open market, because that is the opportunity cost of giving them to the employees instead of selling the same option in the market. I think you'll find generally that if you take a value of about a third for 10-year option, if you take a value of about a third, obviously it depends on dividend rate and volatility, a whole bunch of things, but about a third of the market value, strike price at the time they issued, that's the expectable cost. We believe in using the expectable cost versus the actual cost. I mean, that is how we would look at it. If we were issuing options at Berkshire and we issued options on $100 million worth of stock a year, we would figure it was costing us, probably in our case with no dividend, at least $35 million a year to issue those options. And we would figure that if we gave people $35 million in some other form of results-oriented compensation, that it would be a wash. And that is not the way most managements, of course, figure. At least that's my experience. And we would figure we could use that $35 million in a more shareholder-oriented way, and one where the employee was productive, would be sure of getting results, as opposed to having it be at the whims of the market. And I think you'll see a lot of option repricing. Everybody says they won't reprice their options until they do it. And I mean, you'll see that with a lot of schemes. It will be interesting to see whether Conseco is willing to bankrupt all the executives who made loans to buy the stock and had those loans guaranteed by the company, and the company initially said they would enforce those loans, and we'll see whether they do it. I would say in many cases they won't. I don't know what Conseco will do. But a lot of things that are said in connection with executive in option schemes and that sort of thing are what they'll do if it works in their favor, and then they'll do something else if it doesn't work in their favor, and that's not spelled out in the initial approval that's granted. Charlie, you want to have anything to add?
Well, Warren's somewhat critical attitude is very understated compared to mine.
We're going to leave raisins out of this particular.